Good morning. We are delighted that you could join us today. I'd like to introduce Invest in Africa before I introduce our speaker for the day. So we are a private sector partnership initiative, and our main role is to drive job creation for economic growth. We do this through catalyzing and developing SMEs to grow and to scale up so that we can prosper our economy. We do this because we believe that SMEs are the backbone of this economy, and therefore when we have prospering and thriving small and medium enterprises, we will have a thriving economy. So our mission is to enable trade between all of you and large corporations by making sure that we are addressing SME skills where need be to be able to address the needs of large corporations. We also want to improve your access to markets by making sure that you have visibility for these opportunities through our Biashara.now platform. And we encourage you that if you're not already a member, please today register for Biashara.now to be able to see what opportunities we have for SMEs. And finally, we improve your access to finance. So part of the reason we are having this masterclass today is because we realize that capital, especially at this time, is something important to consider for SMEs. And we not only give the masterclass, we are able through our partners to link you to the finance that you will need. And so far, what has been our impact? So we're working with three main initiatives. The first one is access to skills, where so far through this SME survival program, we have reached almost 1,500 SMEs, and at least 63 have been certified with anti-bribery certificate. This is a trade certificate that enables you to do trade beyond our borders. So over and above that, we also are having access to markets through Biashara.now. We are able to register you, vet you, look at if you have the right documentation and how we can help you to bridge gaps where there are for you to be able to respond to opportunities on Biashara.now. And we have so far awarded contracts worth over 154 million, which supports at least 88,000 jobs. We are looking to do a lot more, and these are not just even job creation, sustaining jobs, ensuring that you're able to keep the employees that you have through supporting your business to be able to recover well and to continue to build resilience. As we all know, we have been affected by COVID greatly. And finally, with access to finance, we have facilitated finance of almost $6 million, that is 600 million Kenya shillings, and of course with a focus on women as well. I'd like to talk a bit about this particular program before moving on, because what we are going through today is what we term as a masterclass. So we have partnered with MasterCard Foundation to be able to deliver an SME toolkit to SMEs in Ghana, Senegal, and Kenya. And these are solutions that are curated specifically to support recovery and to be able to build resilience. None of us has been through such a pandemic before, and therefore we believe this is a golden opportunity to really build our resilience, to be able to face future crises or disruptions that may not be unforeseen. So really just turning around this pandemic into an opportunity for us to build very strong businesses in our economy. So we are delivering 5 main solutions. The first one is for masterclasses, and thank you for attending this one. We have had several before this. We invite you to extend the invitation to your friends, colleagues, and networks. And secondly, we invite you to today let us know in our feedback link, which will be shared at the end of the session, what other challenges are you facing? What other areas are most pressing that you'd like us to address through our masterclasses? So our masterclasses are designed specifically to respond to your needs. Secondly, we shall be having business coaching, and this is this is having a partner, a qualified coach who works with you to be able to provoke that deeper thinking and reflection on what are the ideal next steps for your business. And usually we will have 5 sessions. The first session, and it's a one-on-one between you and a coach and a certified ICF coach, International Coaching Federation certified coach, to really set out a strategy for your business in terms of a particular project or area you would like to receive coaching. That will be followed by 4 sessions of one-on-one, and we encourage you today through our contacts to share with us or to express interest if you would like to be included into our coaching sessions. We'll be coaching at least 200 SMEs one-on-one for 5 sessions. We will also have quarterly peer-to-peer sessions. There is nothing as powerful as hearing from another entrepreneur's journey. Someone who has been there, walked down that road, and you can relate to how they were able to navigate some of the situations or challenges you may be currently facing. So we will have that quarterly. Looking forward to our first one, which will be coming up in October, and we shall be speaking about it in the next few sessions. We also have a Knowledge Academy. These are just quick guides, quick reference guides and best practices that you can refer to. Look at what experts have written about how small and medium enterprises can navigate this season of recovery and building back. So we invite you to always keep in touch. It is vibrant. We are always putting new information in there, and we look forward to really making it even more interactive than it is right now. But I guarantee you, by visiting, you'll be able to get more about it. We will again post a direct link towards the end of the session. And finally, last but not least, and especially important for all SMEs who have today attended the Access to Finance, this financing masterclass, is that we shall have an Access to Finance component where we will take at least 100 SMEs through an investor readiness program. So what we are doing is understanding local financiers and financing institutions. What are they looking for? What are their requirements? And bridging the gap between what the requirements are and where you currently are, making that linkage, working with you over a period of 4 months to make sure that finally you can access the finance that you require. If any of these sound relevant and good for your business or anyone in your network, feel free to share with them. Reach out to us. We are happy to onboard you and work with you this journey as we build back our economy better than it was before this pandemic. So now, moving swiftly into today's masterclass, I would like just to set out the objectives for the session. Then I will invite our speaker. So we have designed this masterclass with 3 specific objectives. The first one is to help you reflect and understand your working capital cycle. So, of course, depending on your tech business, it differs from business to business. But going through this session today, we would like to give you some insights that will help you understand what your working cycle is, and therefore also enable you to improve your working capital. As you know, every business needs positive working capital, and particularly so at this time when we are really aiming to recover and to build back better. And then finally, at the end of the session, we will give you some financing options which are available today. So this is just a fast foot into assessing some of the financing options that are available for your business type. And of course, you may not be able to offer everything and give everything in today's session, but we hope we can open a window or a door that you can go through and be able to assess what else is available for your business, and you may be able to strengthen your working capital. Today's speaker is Linda Onyango. Those of us who have been in these sessions before may have met Linda very early into the COVID period. In early April, she offered us a session on scenario planning and different ways of arranging your finances at that time to respond to the pandemic. Today she's with us again on this particular session. So she started her career early on working with PwC and Olympia Capital Holdings, and in this way was able to really be a support in the launch of the new PwC advisory strategy. Her work has won her some awards, among which is Most Effective Local Support by Barclay Middle East Holdings. This was for her role in mobilizing capital for SMEs in Africa in March 2019. So we are confident that we're in very good hands. She's also been appointed as an SDG influencer to represent Kenya SMEs in 2018 at the first Heads of States Partnership for Green Growth Summit in Copenhagen. Today, she's the CEO for SME Support Center, which is also a partner for Invest in Africa, and I'm sure will continue to work with us this journey of enhancing access to finance for SMEs. Thank you and welcome, Linda. Karibu sana.
Oh, thank you very much. So yes, for me, it's always a high to speak to entrepreneurs. For us at the SME Support Center and Invest in Africa, we really share this vision to see the growth and scale of SMEs. So we are constantly looking for ways in which we can really support each other in this journey through collaboration. And it's such a pleasure to speak on this topic. I know working capital is something a lot of people speak about, but I always wonder if it's something people really understand. Did you really understand your working capital needs and so forth? We get a lot of SMEs joining the center who are not so sure what sort of financing they're looking for and what sort of financial need. SMEs will always tell you, oh, I need financing. But ask them, so how much, what in detail? People are not sure, and sometimes knowing what finance you're looking for can really help in terms of sourcing for this finance. And so that then you're not looking for long-term debt when you're actually looking for working capital finance. So today we've just started with the first one, which is working capital finance. I hope you have your notebooks and your pens and so forth. The brief I got, this is a masterclass. So the assumption is that out of this, you should be highly sharpened at a masterclass level on all matters working capital finance. So just get your pen and your notebook, and hopefully we shall have an exciting time. So it's an honor again to meet you all, and I will try and explain most of these finance concepts very simply, so we can begin. So what is working capital really? What is working capital? The accounting term for working capital is really current assets minus current liability. That is the accounting term. So some of people in the call are not necessarily accountants, but by virtue of being an entrepreneur, you must understand your numbers. That's rule number one. So in essence, it's the current assets minus the current liabilities. What that just means is any asset that you can liquidate within 1 year, and any liability that you owe that you need to pay within 1 year is your current liability. Now, but practically speaking, which is the layman's term, is really, it's the daily, weekly, and monthly cash requirement for the operations of a business. So it is really the amount of money you need in order to operate a business. This can be done at a transaction level and so forth. So I will show you. So this is the general definition. So what are the components of working capital? So we talked about being current assets and current liabilities. So on your left side, you have various components. So you have inventory, which is really your raw materials, the work in progress, and the finished products. This is working capital. The assumption is if you sell it within 1 year, you'll get some cash. You have receivables. These are people who owe you money for goods supplied, goods or services supplied. And you also have prepayments to suppliers. Some of you pay your bills early. I'm not sure whether that's happening during this time, but maybe in previous times, some people pay rent in advance and so forth. That is a receivable. And then you have other current assets. So if you have prepaid some expenses, if you have prepaid like rent before, that's a current asset. And if you have any cash in your bank, petty cash and so forth, it's a current asset. Now, in terms of liabilities, the last two rows, it's really about the amounts that you owe to suppliers and any monies that are prepaid by customers, in which case you will have to refund or net it off against future orders, and then other current liabilities. So if you have short-term debt, that is debt payable within 1 year is short-term debt, and any other accrued expenses. So these are the components of working capital, and it's essentially, if you see the math at the bottom, it's the current assets, which is inventory plus account receivables plus other current assets minus account payables minus other current liabilities. So it's just current assets minus current liabilities. But what really determines the working capital of an organization? What really determines how your working capital will look like? So one is the nature and the size of your business. So if you're a manufacturing company, you will not have raw materials. So if you only buy to sell, you will not, if you're a manufacturing company, you will have raw materials, but if you only buy as a retailer to sell, you will not have raw materials. So that determines what is in your working capital. Operating efficiency, if you keep less finished products, if you sell your goods as fast as possible, then it will determine how much working capital you have. And we'll go into the detail of calculating our working capital as we move along. The firm's production policy. What is your production policy? Do you have a policy around how much stock, raw materials you should get? This is for manufacturing companies. Do you have a policy around how much, I don't know why it keeps moving, but do you have a policy around what are your credit policies and so forth? This will determine whether you have debtors, whether you have accounts payables and so forth. So people who sell in cash will likely not have receivables. It's just like that. So the firm's credit policy, that's what I was explaining. So your policy around how often your invoices should be paid and so forth. Availability of credit will determine your working capital. So some of you don't have this short-term debt in your books just because you have not accessed any debt, and it's really because perhaps you want, but it's not available and so forth. The growth of the business, the truth is as you grow, you will need a working capital facility at some point so that you can meet your trade demands and your production demands and so forth. So how fast you're growing is a determinant of your working capital. The profit margins, and this is very, very important. People don't realize this. So if you're selling a product and your profit margin is, let's say, 20%, you're only making 20%. That 20% is supposed to meet all your short-term obligations and expenses. So it will determine your working capital and so forth. Dividend policy, this is for more sophisticated companies and so forth. So those are the internal factors. In terms of the external factors, you have the business cycles. What that essentially means is that some businesses have cycles. So this business cycle goes hand in hand with seasonal variation. So French bean farmers, for example, there's a period in the year where they're very, very, very busy. So it's around July to September. If you're a French bean exporter, for example, there are seasons around that, which is driven by the market and so forth. So it will determine your working capital cycles and so forth. Changes in technology as well would determine some aspects of the working capital in terms of external. So if you're going to use, for example, e-commerce, payment is by cash and so forth. So technology also has an impact on your working capital cycle. The taxation policy has an impact on the working capital cycle. So for example, for SMEs now, we have the turnover tax. It is at 5%. So that will definitely determine this amount that says you're operating cash. It will definitely determine this. And then you have the price level changes. Price for some businesses is very varying. So you find some businesses, the price fluctuates. And if it fluctuates based on demand and supply, because pricing is about demand and supply. If it fluctuates, that means the amount that you're going to receive is low and the cash that you're going to receive is actually low. So these are the determinants of working capital. And I want you to do this after the call. Just reflect on your business and look at which of the factors are actually determining the working capital, because that is very important. Without working capital and without cash, the business can fail to survive. Really, it can fail to survive. Now, so how do we calculate our working capital cycle? How do we calculate it? This is one of the first math I want us to do after you leave this call today. How do we calculate it? So let's assume we have this manufacturing company called Maker Limited. It makes garden furniture. from timber. So its main raw material is timber. And then it sells the finished products to retail outlets. I picked this case study because the people who sell to retail customers have a harder time meeting their working capital demands. Because retail customers are many, and you're never sure if some maybe you sell by cash, but some it can really affect your working capital. So they sell furniture to retail customers. This is a very complex business because every customer wants different kinds of furniture. So you can imagine. So the first thing that this Maker Limited does, but this Maker Limited has a policy with its supplier that it gets timber and the payment terms are 45 days. Now, this Maker Limited sources the timber, but on average, it holds the timber for 18 days before it's used for production. So it holds the timber for 18 days. So it doesn't process immediately. So that means it constantly bringing timber, but it holds it for 18 days. Now, it takes an average of 11 days to produce the finished products. Once it holds the timber for 18 days, it takes an average of 11 days to make a furniture for a customer. Remember, this is retail. This is retail. So every customer has different needs, different wants, and so forth. So 11 days to produce the finished product. And then once they produce the finished products that they produce to keep, they hold the furniture for around 28 days before they can sell it off to a customer. Yeah? 28 days before they can sell it off to a customer. Now, on average, the retailer buys and then pays after an average of 52 days. So the customer will pay you after 52 days. I know my slides skipped, but this is what should have come first. Maybe we can reflect on the working capital cycle. Sorry to take you back. So a working capital cycle is really the amount of time that passes between using your cash to purchase stock or raw materials and ultimately receiving the money for the sale. So if you're in manufacturing, if you order a raw material, convert it to a good, up to the time the customer pays you, that's the working capital cycle, really. Now, it's important to understand your cycle because it will help you manage your cash flows. Went to the example before the definition. But so if you look at this example that we have just gone through, you do realize the time it takes from the time they order the raw materials to the time they make the finished product begins to define their working capital cycle. So how do we calculate this? Now, the raw materials inventory holding period was 18 days. So this one, he holds the timber for 18 days before it's used for production. So basically, this person is eating 18 days, and this time to pay the supplier is running out. So he's eating about 45 minus 18 days in terms of before he actually starts to produce. So he's eating onto his supplier terms. So basically, you have the raw material inventory holding period. The trade payable, this is a minus because he's eating into these days. The work in progress holding period, you remember he has 11 days to produce and finish the product. So he's using the product for the raw material for 18 days. And then he's holding the product for 28 days before he actually sells it to the customer. But then he's going to only receive the money in 52 days from the customer. So if you look at the math, it's 18 minus 45. The minus on the trade payable days is because it's basically he needs to pay the trade payable within 45 days, regardless of the cycle. So he's already eating into some time. So this is why this is minus. And so you find this guy has a working capital cycle of 64 days, really, 64 plus days. Now, let's assume this guy was what many Kenyans are, traders. Let's assume this guy was a trader. So he basically does not need to buy the raw material. He basically buys the furniture from somewhere. Maybe he imports it. He buys the furniture, and then he buys. So his importer is Supplies Limited. And so he buys the furniture which he expects to sell within 6 weeks' time. 6 weeks' time, if you use calendar days, is 42 days. So 6 times 7 days a week. So that is 42 days. So inventory for 42 days for him to be able to buy the inventory, keep it, and then before he offloads it. But then he has 60 days to pay the supplier, right? 60 days to pay the supplier. And then when a sale is made, the cash arrives in his account after 3 days, receivable days, right? So the working capital really is the inventory days, the amount of time he holds the inventory, which is 6 times 7. Remember, now he's not producing, so he's just buying to sell. So 6 times 7 days, and then the amount of time he takes to receive the money, and then the payable days. The payable days is always like a minus. So in short, he has 42 plus 3 days. 3 days is the payment arrives in 3 days minus 60 days. So he has a working capital cycle of minus 15 days. What this essentially means, if you have a positive number, the number is above 0, it's a positive cycle. If it's less than 0, it's a negative cycle. And the number basically means how long the business is out of pocket before receiving payment in full for its inventory. Remember, I know it may sound complex math, but just remember it's the amount of time that passes between using your cash to purchase stock and ultimately receiving the money. Now, using your cash to purchase stock, if you have a supplier agreement, it means you deduct the days up until the time you pay the supplier. So that's why you see the supplier is minus. If I can explain it in simple terms, I wish there's a way to interact on Zoom. But basically, understanding your working capital cycle. So for the people what you need to do is look at a transaction. So let me pick an exporter. An exporter who has to pay farmers in cash, for example. You have to pay farmers in cash so that then you can export, and then when they receive the goods at the other end, whether it's Netherlands and so forth, you have to be able to determine your working capital cycle and then determine how long you'll be out of pocket before you're actually paid by the customer and so forth. Now, it's very important, like I said, it's important to determine your working capital cycle. Exporters really have negative working capital cycles, and that's why you're always running around looking for cash, whether it's from logbook, financial, and so forth. Just because you have to pay the farmers in cash for the ones sourcing from the farmers, and then you take a while, 30 to 60 days to be paid by the by your client, and then and all the associated costs. So it makes you have a negative working capital cycle. So go and calculate this for your businesses. Now, because we know businesses will always have our working capital issues, what are the trade finance options that are available? What are the trade finance options that are available? Really, I know banks have tried to. We'll talk about who's providing what towards the end. But in terms of trade finance options that are available, I've picked all the options that are available. Whether it's from banks, I know the challenges around banks and etc., and I'll speak about that later. Whether it's from banks, whether it's from private lenders. So the first one is called reverse factoring. Reverse factoring. So this basically allows sellers to sell their receivables relating to a particular buyer to a bank at a discount as soon as they're approved by the buyer. So this is factoring is just basically selling your debtors. So you look at your books, you sell your debtors, the bank makes its percentage. Is it 2 to 10% of the value? They make their money, and so when the buyer finally pays, they pay into the bank account. So this is factoring. Distributor finance. If you have a a distributor agreement with large manufacturers. Basically, they help you cover that time it covers your business during the holding period. So this one then doesn't have that holding period, and it bridges liquidity until you receive funds from the sale of goods from your retailers. This is very good for the ones that are retailers, especially because you keep goods that you may not need and you need to sell it off. LPO financing is a big one. I know the challenges around LPO financing, but the way it has been designed in Kenya, it's particularly for very known, reputable organizations, that where you then, if you have a reputable organization contract, you can obtain the capital that you require to execute the work orders. Lucy, can we mute everyone, please? Thanks. So in terms of the LPO financing, this is particularly for those with the contracts from reputable organizations, and it really helps you to execute your orders. So to get that initial capital before you execute your orders. Now, collateral finance arrangements, this may not apply to some people, a lot of people here. This is usually for MCs, so I won't speak about that. Contract financing, this is again for contract type of businesses. So you have a contract that is phased. It has phase 1, phase 2, happens over 6 months to 12 months. Banks can actually give you up to 70% of the contract value to facilitate your working capital to be able to service this order. Value chains finance, this is what you call the working capital facility. So if you discover your working capital cycle is like minus 30 days and so forth, so you get a working capital facility to bridge the gap. Value chain finance is basically a combination of all these trade options. Now, I don't know why my slides keep going to the end. I had another one. Letters of credit. Letters of credit. Most of you are familiar with LCs, especially if you're an importer. This is basically an LC to your supplier, guaranteeing the payment of goods will be honored upon shipment. So your bank issues a letter of credit that you will then get these goods upon shipment. Now, guarantees, bonds, and indemnities. I don't know whether some of you really use this a lot, but in sophisticated market, there's a lot of guarantees and bonds. I've seen recently RBA capital markets are trying to see how to issue guarantees bonds. This is really a commitment given by private providers to support your trading activities. So it's like, so they're in various forms. So there's either bid bonds to aid in the bidding for contract supplies. This is very common with government. They ask you to issue a bid bond. There are performance guarantees, there are custom bonds, and etc. And just really to guarantee that you will actually perform as per contract. This can strengthen the LPO order. I know one of the biggest risks why people are not giving a lot of LPOs outside of the collateral, it's mostly because no one can guarantee that if I give you money against an LPO, that you will actually perform to the required standard and the required level that would actually ensure that you will eventually receive payment. So things like performance guarantees can really help. And I know insurance companies are really working towards providing this. Standby letters of credit is almost similar to LCs, which is really a commitment of a payment to a third party in the event the client defaults on an agreement, particularly common again for importers and so forth. Bill avalization, don't mind the terms, they look very complicated, but it's almost like, this one is almost like the LC almost. It's almost like an LC. And I think the main difference between a bill avalization and LC is really the terms. The terms are much more better. The terms are much more better. Remember, for things like if you're to strengthen your transaction with bonds and etc., you start with about 2% to 5% of the contract value. It really needs to, you need to really think about your margins. What are your profit margins and whether you actually can cover these bonds and so forth. It's always about, to a financier, It's always about strengthening the transaction. The more you strengthen the transaction, whether it's a performance bond and etc., the more guarantee you have to get the money. It's really about transactions. When we do transaction advisory, we look at the transaction and the strength of it. Invoice discounting, many of you are familiar with this. A lot of people are offering this. These private lenders, they're offering this. And it's really, they really look at your unpaid invoices, they confirm which debtors they are, who is this that owes you money. And once they confirm with those people, basically some require that those people will actually pay them directly, but basically they discount your invoice. That word discounting really just means if your invoice is 100%, it's 2 million. If a customer owes you 2 million bob, it basically means they discount it maybe to about 80%. They can only fund you maybe to about 80%. That's what it means. And then invoice discounting is for a period of about 180 days. So within 180 days, it's expected that you should be paid. And once you're paid, the money goes to offset your loan. Now, invoice discounting releases money from your debtors. Remember, when we're talking about what is your working capital, is current assets minus current liabilities. So if you, it basically releases money from debtor to cash, and you're able to source more products for sale and so forth. So if you have invoices, especially some of you who are retailers, there are people who can help you with invoice discounting, and I'll speak a little bit about that. This is very good for people who if you're sure you're going to be paid for within 180 days, it is good. The charges for invoice discounting range again from 2 to 5%, depending on the player. If some are Shylocks, it can go up to 5% per month. So if it's 180 days, it's 180 days is 6 months. So you can imagine that cost to your business. So remember, it's around 2 to 5% per month, at least the players I have seen working across. So it's a very heavy cost to factor in. Now, finance options and your working capital cycle. So how do the finance options fit your working capital cycle? So if a customer places an order, let's assume that customer is a corporate customer, then you qualify for purchase order financing and so forth. If it's a credit-worthy customer, please note credit-worthy customer. I know that has been the main reason people have really refused LPOs. On top of that, if you can have some performance guarantees and so forth, you could be able to get an advance around that. Now, once you place your order with your supplier, and the supplier needs payment. This is where a lot of SMEs are. You've placed an order, the supplier needs payment in cash. If you're importing from China, I meet a lot of those people. When you go into town, whether it's Moy Avenue, a lot of people source goods from China for sale to the retail market. So the Chinese people, a lot of them want you to pay cash unless you've developed a relationship. They want you to pay cash. What is your recourse? You have LCs and so forth that can help you strengthen the transaction. That's assuming you have the necessary collateral for the banks, because the current LC providers are the banks, and they require collateral. And I'll speak a little bit about the various profiles of businesses that we have in Kenya as we move to the next slide. But let's assume all factors are working optimally, and you can get an LC, which can then support your transaction. So most of these Chinese people are okay to work with an LC from a reputable bank. At least I have done that for a couple of clients. They're willing to work on this. There are private providers, some of them based in the US and so forth, but some of them you have to be very careful. They're not very, very credible. If you Google private LC providers, you will see them online. Yeah, you will see them online, but usually what they issue is not an actual LC. So you find like your supplier will not be very comfortable to give you goods on that basis. So if you read the terms, they have very many clauses that make it not look like it's so binding, and many suppliers will then end up rejecting that. Now, Once your supplier needs payment, you have the goods have been shipped, they have come to you, you have received goods, and so forth. Once you've received goods, there are options for stock finance. So because if you're a retail trader, if you're going to sell to the retail customers, let's assume, let me use one client that I have. He sells ETRs, ETR machines. He's going to offload them to the retail market. He'll only offload all of them. The one consignment he will get, he'll offload them over 6 months. So what can he do? He can consider stock finance. Stock finance is actually available. There are banks who provide stock finance. I know Diamond Trust Bank actually provides stock finance. So you basically get financing on your stock. That's really what it means, especially if you know you need to bring some things in advance, so that by the time this one finishes, you don't keep your customer waiting, and so forth. These are for the people who have huge turnaround with retail customers. So before you clear them at KRA, it's another 1 month and etc. So you can consider stock finance to hedge against your stock. Invoice discounting, I talked about it. This is where you have a debtor, invoice raised, and so which is really give you an amount, usually less than 100% of the value of the invoice. And then there's also factoring. Factoring means you basically outsource everything to the financier, including the collection process. So they're the ones chasing your client on your behalf. So factoring and invoice discounting is the same. It's just the difference is that invoice discounting, you're the one who still keep chasing the data, but for factoring, it is the collection people who will chase. Now, and this is where I want to spend a lot of time on. I know a lot of SMEs have really complained. Linda, there are all these financing options, but the reality on the ground, which ones? The reality is that we are not actually getting, if it was like this, where SMEs crying for money. Because the truth is, as you start as an SME, the one thing you need is maybe not long-term capital, especially if you're traders. Kenya has a lot of traders, a lot. In fact, is it 65% are traders? I speak a lot about this. You can see the articles I have written about this, and this is my latest article. Kenya has a lot of people trading. So you have local retailers. So these are like the shopkeepers, the shops in your estates, and etc. Or the small micro. So some are very old, 0 to 20 years, some are new, some are starting, and so forth. They sell to retail customers. I'm just painting the landscape vis-a-vis what is available for you. So you can map yourself where you are right now. Now, these local retailers, they sell to retail customers. So when I say retail, if it's a jargon for you, I just basically mean you sell to individuals. You don't sell to a corporate. That's what it means. And then, so you find these kinds of people. So these are your local supermarkets, people who are doing goods and services. So you have salons, you have butcheries, you have shopkeepers, these small shops in the estates and etc. Mostly, many are informal. So these are talking about micro and a bit of small, lower small. They typically informal. They're subsistence micro traders. They sell household or subsistence items, so things for use, whether it's maziwa and etc. They buy and sell in small quantities, keep stock depending on traffic. So these people need finances to meet the day-to-day needs. So who has come in to help them? So this one is where you find the fintechs, the microfinance, they play here. So the fintechs really played in this space, where you need something less than $2,000. I speak a lot in dollars. $2,000 is 200K. If you go to visit M-Shwari and etc., I think they can give you up until 250 based on your transaction, 250,000 Kenya shillings, which is like $2,500. Now, these ones have been met by fintechs. The fintechs basically cover these guys and MFIs and so forth. These are small traders, subsistence. Now, then there's this category B of people. A lot of SMEs are in this space as well. Maybe you're a local importer or local supplier. Supplier here, it means maybe you're manufacturing, but you supply locally. You're less than 3 years old, some may be more. some on the call are more. So you're less than 3 years old, and this person sells to retail customers. Retail is very hard. So you get stock and you move slowly within 6 months. So you're formal, yes. You have limited physical assets, no collateral. And then you sell your goods over a period of 60 to 90 days. It can stretch to 180 days. The retail clients, they tend to pay for cash. They tend to pay in cash. And then the main issue here is that you have to pay in cash to your supplier before delivery or manufacture of goods. This is what begins to bring the working capital issues, right? So if you're importing, your consignment is usually $2,000 to $50,000. The ones I've interacted with in this case, they haven't gone more than $50,000. You don't have financial statements. The ones that the bank required, and you don't have collateral. So basically, you need initial working capital to service your order without collateral. And if you're in manufacturing, you need a working capital facility. Now you're less than 3 years old, you don't have collateral, so the banks are out. Because banks will require collateral even for LCs and all these kinds of things, unless they've been trading with you for a long time. Your recourse is who? Family and friends. A lot of you meet logbook financiers. I see many of the ones who come to SSC meet logbook financiers. That depends on how big your profit margins are. But you need to have a car to give them because they're still asking for logbook financiers. So the interest rate is up to 10% per month, even some more. I'm told even more, even up to 20%. You can imagine how that eats into your margin. And then some of you who may have developed some relationship over 1-2 years, you can get distributor finance. And this is very important. If you're importing, if you're a retailer, identify a key distributor who you can work with, and then they can give you goods, and then you can pay them as you sell. This is always push for distributor agreements because they can come with access to finance, especially if you're still young. And then you have private cash flow or sales financiers. Now in Kenya, there are not many. I've been studying the landscape, there are not many. In South Africa, they're very advanced, and I'm pushing some funders to actually go this way. South Africa, they're very advanced. Basically, what happens if you're a retailer, if you have a clothes shop, let's say you have a clothes shop and you sell clothes. So they can advance you as you sell. As you sell, they advance you. As you sell, they advance you. So you see, that's immediate, it's fast. You can Google them. People like Merchant Capital, Funder. I've written an article around this. You can find it. I think I uploaded it on LinkedIn. You can find it on LinkedIn and comment there. So these are people who have discovered this segment B of people who really need help. So the difference is that this person is indeed still young, less than 3 years. They sell to corporates. So in each case, this person at least has these are the formal ones still. You have limited physical assets. You have a corporate tender to supply. You have limited trading history with the corporate. So if you're supplying Safaricom, you're not at that level where Safaricom can advance you some credit and so forth. Each contract averages $2,000 to $50,000 and so forth. So what happens to this kind of a person? You can access purchase order financing if you have collateral. Your key needs a purchase order financing because then you have a purchase order from corporate or government. And then your key needs are also like a working capital facility. Now, who is there for these guys? Even Shylocks and logbook financiers, they will still need the logbook, like I said. But there are innovative models that are coming up. Business Partners International in Kenya is one of them. But they can only touch you if you're at least 12 months to 2 years. So there's a huge need on this sector. There's still a huge need. I appreciate the huge need. And some of us are really working to change this. Now, part D is where everyone, these are the lucky guys. If you're an SME in this space, you're experienced, you're selling either to retail customers, corporate or government, you you've amassed some personal assets, you've bought some land because of your retained earnings, because of your profits over the years, you have some financial statements, you have a trading history. These are the people who get a lot. So local banks can fund you, you have private lenders, private innovative cash flow for suppliers. I could speak a lot about this. You have working capital solutions from corporate buyers. So for example, if you sell to Safaricom, for those who have been inexperienced with them, they have ways in which to support their suppliers. So I know some of you fit in one category or the other, A, B, or C, or D. This is based on our analysis over the last 3 years supporting SMEs really in this space. You must belong to either one of the space. I think the key issue for you is to ask, how much pricing based on your profit margin are you willing to take into account? Do you have collateral? If you don't have, what is your recourse? And how long will I take to receive this money from my customer? Those are the key questions you need to ask yourself. This topic is very long, and because we are doing it online, it's not going to be very interactive, but I hope, I'm hoping the question and answer session will be really rich. That is a lot of what I wanted to share. So thank you very much to Terry, Wangeshi, Lucy, and the team for having me. I know it's been quite heavy, but I'm very happy to take your questions. In case you need to find out more, you can always register on our website, www.sme-supportcenter.com. Fill in your details, and our promise is to get back within 24 hours. At times we make it 36 hours, but usually what we want is for you to fill something like an initial screening form, and that way we can identify your need early on. So by the time we are getting back, we are giving you some solutions. So over to you, Lucy, to moderate the questions.
Okay, thank you, Linda. And the chat has been quite engaging. We do have a couple of questions, and perhaps you can start on with this one from Pauline. She's asking, please explain the bill's avalizations more.
So yes, the bill avalization is almost similar to LC, the LC financing. The difference is in the clauses. Before you engage a bank, if you're going to sign a term sheet and etc., the difference is in the clauses. So what it does as well, if you're an importer, it gives assurance to the importer that you will actually pay them. The difference is on the basis of a bill of exchange, but it has some more lenient clauses to the SME. That's the difference.
And then, Linda, we do have one more question from Baji. He's asking, how do you factor in cash payments in the working capital cycle? What he wants to understand the impact of cash payments in the cycle formula.
Oh, great. It's a very, very good question. I hope you are all following. I hope I wasn't too fast. But basically you see why you don't factor it. In my example, why you didn't see me, because working capital cycle is about remember, whether it's inventory days and etc., you're already factoring cash indirectly. So let me explain. You're already factoring cash indirectly. I wanted to reproject my slides. You're already factoring cash indirectly. So when you factor it in, the number of days it takes to receive payment from your supplier, you're talking about cash. When you talk about the number of days it takes to receive payment from your customer, you're talking about cash. When you talk about the number of days it takes to work on your inventory, you're still talking about cash. So indirectly, the cash is really factored in.
How can one access venture capital for a profit social enterprise at seed level?
At what level? What did you say? At what level?
At seed level.
So I was saying at the cycle on the VC side is really, you have an idea, you move from an idea to create a prototype, you move from a prototype, you go into the market, you test your solution or product, and from there, which is really the pilot, and from there you go into what we call validation. You start selling to customers, start getting breaking even, maybe at a gross profit level, and then you go into the next stage, which is really growth and scale. Now, at that seed stage, at that seed stage level, if you only have an idea, your chances of getting money are very, 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 very limited unless it's competitions, unless it's this calls for business grant, this calls for innovations and etc. This one's either in education, in agriculture and etc. And you can imagine there are tens and thousands of applications, and they're only looking for 5 top competitions or 5 top. What I always encourage entrepreneurs, move the next step. If you can convince a friend to give you 50K to turn it into a product, go to that next step. Because if you play where many people are looking for this money for competitions, your chances of actually getting money is very low. It's almost negligible. So if you move it to a prototype, test, show that there's some customers and etc., then you begin to face some of these early stage financiers and so forth. Now, I don't know whether I want to answer the question and I've sort of forgotten it, but I think the key thing is what are the options out there? What are the options out there? In the VC world, it's about innovation. It's about, is my solution really going to provide cutting edge and etc. So you know the metrics that they look for. So the more innovative your idea or your product is, most likely you are able to get some funders. If you look out to our SME support center page, you'll see we constantly share some of these opportunities. Feel free to register. If you're in our mailing list, we'll give you all these. Every week we summarize and we send you all the opportunities that are available for you to apply. I can't narrow them down here. We have some in education and etc. Funders in education, grant funders in education and etc. If you're in education, we strive to send you some lists in education. And it's up to you to check. We only act for you if you specifically engage us to act for you. So I encourage you to register. That's what I can say. I can't narrow them all down here. But if you're early stage, your best bet, if you just have an idea, your best bet is competitions, to apply for competitions, which are very competitive. Your next best stage are these early stage funders, and those depend on sector. They really depend on sector.
Kindly, yes, kindly still on that, my name is Sarah.
Yeah.
I wanted to know, you've moved from the initial stage, you have a prototype, it's working, you've sold and it's doing well. Mm-hmm. Which is and probably even you've gotten even options abroad, people wanting your product abroad. Which is the best? Which is the best way to go? Which financing option is best?
Okay, so you're now at validation stage. Your financing option depends whether you can be able to access debt. How old are you in business, or how old is your business? It goes back to that landscape.
12 months, maybe 1 year.
Just under one year. Good. Yeah, and that's very important, because then funders, you will know whether you qualify for debt or other alternative options based on your business level. So you're less than 1 year. Which sector are you in, if you don't mind?
This is I think agribusiness, agro processing. I make flour from tubers.
Amazing. So exactly. So private lenders. So let's assume we don't have collateral, so we've locked out the banks. Private lenders the difference between private lenders and banks is that they don't insist on collateral. Now, private lenders will also want some trading history, the truth, the fact of the matter. Having worked with a lot of them, even the ones that are local, they'll want some history. Now, some of the models you can employ, if you are at least 12 months old or 1 year, 0.5, you can consider debt if you don't want to consider equity. And the truth is, debt transactions are faster to close. I focus a lot on debt transactions, even from private lenders. Now, your best bet are people who can be willing to maybe share profits, like share profits. So for example, if you have a seller, if you're a buyer you said you can export. If you have a particular transaction where you have a particular buyer and you're clear on the profit and you're willing to share the profit, you can contact people like Business Partners International. They do profit share models, but then you have to be more than 12 months. You have to show some trading history and so forth. They also need that. I've given you a very practical guide. So you can go for profit share models. You can go for profit share models. You can go for the only reason why some private lenders that we work with, you can go for debtor finance, collateral. I mean, the things I talked about up there. Invoice discounting is something you can go for. Those are faster than having equity conversations at this time. You can go for invoice discounting. So if you have some debtors in your books and there are particular buyers, all we need to do is ensure that those debtors are willing to confirm that they will pay you and all that, and then you get financing on that basis.
Hello, Linda.
Hi.
Yes, my name is PK Ndongo. I am in service industry. I'm an insurance agent. Today, basically, you have start code with the product working capital, but also from where we stand, also we need working capital. So I don't know if you are going to have another session or maybe engage you privately so that I can be able to learn how I can be able to source for working capital from you there.
So two things. I know in terms of Invest in Africa, there's a comprehensive access to finance program that is coming up. I think Terry spoke about it. I would encourage you to sign up for that. It's going to be very detailed. Like for every participant on this call, I'm sure Invest in Africa will really work to ensure it's a very interesting program that is going to be like very customized to each business. You can see the advice I'm giving. I missed the name of the lady making the flour. It's always about looking at your business and breaking it down separately. Now, whether you can connect with us, feel free, please connect with us. You may not get me directly, but I like to see, we fill an initial pre-screening form. If you go to our website, it's www.sme-supportcenter.com. You will see a register button, fill the pre-screening form, and based on your needs, we should be able to advise you on the next steps.
Hello, Madam Linda.
Yeah, sure.
Hello, Madam Linda.
I can hear you very well.
Yeah, my name is Maina Muzui. Mine is, you've been talking about supply of goods and services. Where is we've been talking about supply of goods and how to finance the working capital is all on goods. Where are the services?
Good point. I'm also a service provider. Good point. So where are the services? So I should have put a disclaimer: is supply of goods and services, but regardless, the process is the same. Even if you're like, for me, let me use my own. Which is your business? I can use your business as an example, or I can use my own business. What is your business? I'll tell you how to calculate your working capital cycle and etc.
Consultancy services, tax, accounting, audit.
Oh, sure. Tax, accounting, audit, which is really what we are as myself, right? Now, the truth is, so when it comes to our working capital cycle, for us, we are not buying goods and etc. The person providing the service is myself and yourself. Now, it's expected when you get a client. So for us, there's no inventory days, there's no raw material days, there's only the data days. There's only the data days, there's no supplier, so there's only the data days. So how you turn around your cash is from the time you work on the project to the time you get paid. That is your working capital cycle. Now, on the funding side, when it comes to people like us, the truth is, the blunt truth, I'm usually a very honest person, the blunt truth is, it's very difficult. Where you can, when I worked for the KPMGs, the bigger firms, we used to get, if we supply to a bigger, a corporate, an etc., you can get invoice discounting even for service companies. You can get that. But it has to be, again, invoice discounting is about a reputable client. It has to be a reputable client, whether it's Safaricom or it has to be that you're supplying to a corporate customer. you can get invoice discounting even for services. And I think a lot of people don't know that. But the truth of the matter is, when it comes to venture capital and private lenders and etc., who will give you money? It's expected that once you need to factor in your payment in the delivery cycle. So if you need to it's how you break down your consultancy, that I'm paid every month, or I'm paid if the deliverable takes, you shouldn't make your deliverable take more than 6 months, and so forth. The truth is, when it comes to service companies like ourselves, the payment from the customer is really dependent on the quality of the service, which most lenders don't want to get involved with, because they don't know how yourself, Mr. Ndugu, you will deliver this tax accounting and so forth. You only get to that point of invoice discounting and etc. when you're a reputable brand and when you have corporate clients. But in the meantime, the truth is to get customers and have them pay you in a structure that will meet your cost. That's the basic truth. In terms of private funders, I get consultants telling me I need this private funder to come and help me service and etc. It's expected that to structure your contract, you should be able to meet. Now, that is why we have things like advances. We typically bill advances. You have an advance fee to meet your initial working capital. If you need to hire someone else, you have an advance fee. So it's how you structure your engagement if you're a consultant.
Very well, I get to hear you, but possibly I could ask you to run an errand for me to invest in Africa. The fact of the matter is that as SMEs in consultancy business will not get to a point of supplying or delivering or giving services to corporate. Like, I'm a very small timer guy, okay? But Invest in Africa will support guys who deliver or who supply goods.
So the truth is, if you have a client, factor in your working capital requirements in the billing cycle. That is the truth. That's your initial immediate action. Like, factor it in. Even if it's for the small players, I work with small players. I consult for SMEs, but we have an advance fee and so forth. So it's the same thing. I think it would be too much to expect. I don't know.
Okay, Linda, the conversation can go on, and just a reminder, as we started the session, we insisted that this is a partnership initiative. We are running an ecosystem whereby you will find more corporates to do business with. You will find investors, to fund your business, because as I go through the questions, what most of the SMEs are asking is, where is this working capital? Who are the grant financiers that you can connect them to? And so we are making a call that join the biashara.now, whereby you are able to link up with the fellow entrepreneurs, with all the funders that you are looking to support your business with. And Invest in Africa being an intermediary between you and all these investors or the corporates, the bigger corporates that you're looking to do business with. We are sure to link you up through our online platform, that is the biashara.now. And so on the chat box, we have posted a link on feedback. We'd love to receive your feedback on how better can we support your business, how better can we handhold you during this critical moment. And there was a question that was posted for you, Linda, if you are able to just highlight few of the grant financiers that you are working with. I'm not so certain whether you can do that. And then we do have another question that somebody is asking you whether you can become their board member for a startup. So we have shared Linda's contact. Feel free to connect with her. Feel free to give us your feedback through the link that has been shared by Raphael on our chat box. So over to you, Linda.
Okay, great. I laughed at the board member, not because it's I like entrepreneurs who are bold, not because it's a bad question. I just, I think the only reason I laughed is I receive a lot of requests to be the board and etc. It's always about whether I can add value. And like Lucy said, just chat me up. at times I'm very slow on my personal email. I know my colleague is on the call, but yeah, feel free to write me an email with your business.
Okay.
Well,
Okay,
that's one
Linda,
startup for us.
Yeah. So if you allow me,
sorry, go
could
ahead.
Could I just give this opportunity to one of our SMEs that we are working, Dominic from Polycon.
Sure.
Before we answer the questions on grant on the grant partners that you're working with. So Dominic, this is your opportunity.
Yeah, thank you very much. I hope you can hear me.
Yes, we can.
Good. Linda, that was a fantastic presentation. I really loved it. I am in the private sector and in the service sector industry, but now our private sector, as opposed to most of the other private sector, service sector, whereby you're only doing the service, we need things to do the service. We need equipment to do the service, but we don't supply the equipment. And I think this is actually a challenge both to Invest in Africa and also Leader as a consultant, to really see how we can be able you can be able to advise on how you can support the service sector in terms of obtaining the funding. The other day, I was actually challenged in an international place why Kenya does not have a Ministry of Service. We have a Ministry of Industry, we have Ministry of everything. Although I was asked, I did not know why, even in the government, we don't have a lot of support for service industry. In fact, people think that service is accountancy, services, but we have a lot of service that we can be able to provide. What happens in the world? Is it only in Kenya where we don't have financiers for service? What happened to the rest of the world? Yeah, who finances all these engineers who come and make the rockets? They don't sell the rockets. So that's a challenge I'd like to put through to Invest in Africa, and of course to Linda mainly.
Okay, great. It's a very good question, actually. Should I go, or Lucy, you want to take something else? Okay, it's a very good question, actually.
Carry on, Linda.
Yeah. So when I started, I say at some point in my presentation, I said 65% of traders in Kenya are actually goods and services makes a good portion of that number, the 65% of MSMEs. Now, I get you. So people like garages are in service, you're right. People like, let me just break down some examples. Garages are in service, so they require equipment to be able to offer you the service centers for cars in service and so forth. So they require some machinery, working capital to be able to do that. What are your options? Usually, which is why I provided that table. These lenders are willing to fund all sort of businesses, whether you're in service and etc. The difference is what will determine who you go for is really the stage you're at your business, your ability for collateral. So if you're less than 3 years, you don't have some financial statements and etc., it will determine who you go for. So for example, I'll give an example. Right now I have a garage company service. It's about 3 years old, and they have some financial statements, and we're in consideration with the private funder. And the only reason we are doing that is because they have debtors. Remember, I talked about debtors are the same, whether you're in service or whether you're in goods, you have debtors. So it means you can access invoice discounting, whether you're in service or whether you're in whichever sector. So such a garage, if it services like like that particular garage, their clients are like Red Cross and several other clients, we can actually just separate that from a long-term debt, look at the debtors and finance that. So it's always about looking at the transaction. So which is what I want you to take away from this. Look at your business, look at the transaction you're going for, which stage of business you're in. I give the options there, and then decide who you go for, whether it's debt and etc. So service companies are also not left out. The only issue with service companies is that There's also asset finance for like matatus in service. They provide us with the transport service. They get asset finance for their matatus and etc. There's also asset finance. What I know, banks will not, if you don't have collateral, that's when it becomes tricky. For private lenders, it's the quality of your debtors. You can get some funding. So it's just options. I can't say they're completely no. Obviously, it's not enough. But especially for segment B and C that I spoke about, you can read more of the article in my LinkedIn post. It was on Wednesday. It was on Tuesday. There's need for more players for those who are less than 3 years old, and the ones who don't have collateral, the ones who have some track history of about 12 months. What the lady with the flower, I'm very poor in names, etc. There are very few options less than 3 years old. And that's what we should be focusing on strategically as Invest in Africa and ourselves. Yeah.
Yes, there is another comment here that it's really a good opportunity for our SMEs. I'm not so certain whether this question is directed to Linda or Invest in Africa, on if you are a member of any government body.
I didn't get the question, sorry.
Are you under any government body?
No, we're not. We are a private company. I know some people confused. SME Support Center is not an NGO, it's not a government body. It's a private company.
Yes, and just to reiterate more on those that are asking for the impact investors under different sectors, like I've said, Invest in Africa is a partnership initiative, and it's actually a vibrant ecosystem that contains all these investors, the banking institutions. We do have partners that do offer skills development. We do have partners that do offer market opportunities for our SMEs. So if you don't mind, we'll share a link on how you can become a member of Biashara.now. It's through the same platform that you can connect with expertise like Linda herself. We have shared contacts. I believe we can all view our contacts. Let's connect with her. And at this point, I would love to hand back to Terry Kinyua, if you are still with us.
Yes, I am here, Lucy. Thank you very much.
Yes. I'd love to hand over the conversation to Terry Kinyua for the final bit of our session.
Okay, thank you very much. I would like to take this opportunity, Linda, to thank you for that very insightful session and very practical session. Thank you very much to our guests for having joined us and stayed to this point, and for a very engaging and lively conversation. I'd like to just again go over what we are doing as Invest in Africa, which I believe will respond to many of the questions that we are receiving now. So just to remind you that we are a membership organization. We are a network which has different stakeholders within this network, all brought together with the mission of supporting SMEs to thrive in this economy. So like I mentioned in the past, we work with partners who also grant finance to SMEs, and we work with partners who help us in building your capacity to be able to access that finance. So in terms of investor readiness, with the questions that you have, I see many people who have asked specifically, where are these people? How do we meet with them? So if you have gaps between the finance you're trying to find and what you need, we will work with our partners to make sure that we can help you to bridge that gap and be able to access the finance and link you to the finance that you need. We are also a membership in that you need to join Biashara.now, and I've seen a question on how to join Biashara.now. We will be reaching out, but basically they can share websites right now, www.biasharanow.com. By clicking on that link, you will see a button to join. Please join. There's 1 year free membership using the code here for you. I hope Lucy will put in the code in the meeting chat box. There's a code here for you, so please register today. you've had what we are offering, and this is all meant for you. We support indeed both services and membership. So in terms of access to markets, many of our corporates don't just need products, they also need services. So by going to biashara.now and looking at our tender space, you will see that we have opportunities for services as well. When you register to join biashara.now, please indicate if you are a consultant. Actually, right now we have a drive for registering consultants who will not only support our corporates, but will support other SMEs. So as we all know, SMEs need these services as well, and especially this year they need the services because they may not be able to retain a full-time resource in that. So kindly join us and connect with us. All our information is here on the contact sheet that you see. Thank you, and Lucy for moderating. Asante sana.